Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday, the 15th of, 15th of March. It is officially somewhere between the 12th and the 15th of last year that this whole lockdown started. So it's been officially a year. And boy, oh boy, what a year it's been. Markets made multi-year lows, rallied, and now we're below the 50-day moving average on the Nasdaq again. It is definitely a trader's market. So what do I always say? Let's get into it right now. Let's start with what to expect this week, market moving news. Then I'll talk about global economy, and then I'll talk about the stocks that you need to focus on right now. In terms of global markets, we've got, as far as the news this week, the big news report is going to be FOMC and the Fed Chair Conference. And I'm really interested in what he's going to say about long-term rates, short-term rates, and inflation. Because as you could see here, the 20-year plus, the long bond, made a brand new low just Friday, and it's right now like tithering right at that level right now. And all bonds, I looked at bonds, 5-year, 10-year, 30-year, they're all in the crapper right now. So lower bonds, higher interest rates. Higher interest rates, more pressure on tech stocks and speculative stocks. But I'm really curious what the FOMC announcement is going to be and what the Fed is going to tell us. Now, we've got retail sales tomorrow. That's going to be really big. Retail sales have been better than expected because of the stimulus. The money's been coming to people's pockets and going back out the other side. I'm curious to know if retail sales is picking up, if the numbers are overheating or not. But retail sales is going to be a big report tomorrow. Import and export prices are not going to be a big report because we had the PPI and the CPI last week, Consumers Price Index and the Producers Price Index, and they're actually in line. They're not all that far apart. So we are seeing some inflationary pressure, but nothing crazy. Another big report tomorrow is going to be the industrial production report. So you got industrial production, import and export, not so big, retail sales big, and FOMC begins, which means the market could be a bit subdued till we get the news on the press conference, especially the bond market. But the bond market's really driving the stock market right now. So it's always driving the stock market, but there's a huge relationship right now. There's like a huge correlation between the bond market and the stock market, more than usual right now. Then Thursday, you've got the jobless claims and you got the manufacturing index. So this week, we're going to have a good idea of where we stand with the Fed. We're going to get a good idea of where we stand with retail sales, and retail sales makes up 2/3 of the economy. And we're going to have a good understanding of the Fed manufacturing index and jobless claims. Now, jobless claims is going to be the biggest report of the week. And I'm hoping, you see the consensus is now changing. We're now looking at 675,000. I'm hoping, fingers and toes crossed, that we break the 700 barrier. Consensus is 718. But consensus range is now moving away from the mid-800s. This is the number of claims reporting last Friday. So this is a very current report. And as of right now, it's telling us we're expecting a lower number. The 4-week moving average is 759,000 new claims. We went as low as like 712 last time. And I'm hoping we can break that and go lower and hit the 600,000. If we can hit the 600,000, that means people are filing less, the COVID vaccines are working, the economy is restarting or kickstarting again. And it's really important to see this. Most importantly, this is a really important report because it's so timely. It doesn't report once a month or once every 2 weeks. It reports every week. So this tells us what happened for the week of 3/13. 3/13 was last Friday. So this is a really important report. We're going to get it, and I'm hoping the number will be in the low 700s or break into the 600s. Again, I'll keep you posted on this all week long. Now, as far as the stock market, we're still trading below the 50-day moving average. We're still in the twilight zone on the Nasdaq. And we're not going to be bullish until we're 2 days above, completely above this blue line. And we're not there. We hit it hard last week and we bounced off the 50-day line. And now we're just kind of sitting there. But with the bond market moving lower, like you see right here, we're at new lows, the swing lows. Let me go to a 9-month chart. 9 months, 1 year. Let's see here, 2 years. You can see here we broke a 2-year low on bonds. And that's telling me that tech stocks are going to see more pressure. Not necessarily financial stocks or real estate stocks or other stocks, but the bond market breaking is not good for the Nasdaq 100 because investors are concerned that the yield from the earnings per share yield from the Nasdaq at the end of the year is not going to be all that great on a risk-adjusted basis in comparison to the bond market. Because look, lower bond prices, higher yield. That means interest rates are higher. So that's a big, big, big concern. And that's causing more impact on tech stocks because tech stocks are the ones that outperform the broad market. Financial stocks, those are all in line with the market. Those are the next to get hit. But right now, the question is, well, will tech stocks be able to outperform on an earnings basis beyond a substantial amount what the yield on the 10-year will be at the end of the year? And they were expecting the yield on the 10-year by the end of the year to be at about 2.5%, which means interest rates are going to go higher and bond is going to drop further. But I think we're going to see a little bounce. I think we're a little overdue. We're seeing negative divergence. Let me show you that. I think it's too much too soon. So ultimately, I think bonds are going to go lower, but I think we're going to see a little more upside before. That's negative divergence. That's actually the opposite of what we're seeing on the S&P. And that's telling us that price is making lower lows, but the momentum levels can't sustain that. And that usually leads to a bounce. So I am expecting a bounce, which will give us a bounce in the Nasdaq 100. But the question is it just going to be a bounce? And are we going to make new highs? Or we're going to kind of truffle around this level and go down? I personally think we're going to go lower on the Nasdaq. We're going to need to hit the 200-day moving average before we wash back out. And I say that, and there's not going to be anything new here. I'll show you why, and it's the same reason as always. Momentum, momentum, momentum. We still have 75% of stocks trading above the 200-day moving average on the Nasdaq. And as you can see here, this is going lower. And if this is going lower, that means the number of stocks trading above the 200-day moving average ultimately has to go lower. And that's why I believe the Nasdaq is going to have to come, let me just bring this here, come down a little lower, break the slow, trigger a lot of sell orders right around this level, force out the weak hands. That's what I wanted to say. I got tongue-tied. Yeah, but shake out some weak hands and then start coming up, and that will go along with the momentum levels. Now, I've got two stocks for you right now. There's been a real big interest in trading lately because of the stimulus. The stimulus is money for people. And let me show you something else. If you look at Stock Fetcher, if you look at my filters, you will see, let me just kind of go through this with you. You will see my 10 indices: energy, then financial, then material, then industrial, then material, then real estate. Consumer discretionary and technology are going lower. They're not going higher. Let me show you this 3 months ago. 3 months ago, no, I guess 3 months ago, they were a little higher, but let's go a little further back. Let's go 6 months ago. Technology and consumer discretionary. You see that? June. Let's go back to today. But you could see here, we're now technology and we're all the way down here. We're moving lower. We're not moving higher. Now real estate, I think real estate was actually, let's go back a month. Yeah, real estate was lower. Now real estate is above tech. See where technology was February 9th? This is what I was talking about. February 9th, which was, let's see here, that's a month ago. That's 5 weeks ago. 5 weeks ago, technology and consumer discretionary were in third and fourth place, and real estate was all the way down. Notice energy and financial are not changing. So we go back to today. That was 22 trading days ago, so it's about a month ago. But now you have technology and consumer discretionary lower than real estate, and energy and financial are still leading. And I think that will continue. So the trading stocks like Chicago Board of Trade, Chicago Board of Options Exchange, those are financial stocks. And I told you guys, I think financial stocks are going to go higher, and I think more and more people are going to be trading right now. Commodities for sure, because we're seeing inflationary pressure. Inflationary pressure, financial stocks going up, CME. So commodities, price of lumber, price of copper, price of coffee, commodities are going up. It's inflationary. It's normal. As commodity prices go up, more people will start trading commodities. Where do they trade commodities? In the biggest commodity exchange in the world, CME. Made a swing high, made a multi-period high, not a 2-year high, but we're above a 1-year high now. We're at the highest price in over a year, which means we're above the level of last March where we broke down. And we, as you can see here, we made a swing high, we made 3 days down, and now we're going to go up again. We're way above the 50-day moving average. We're way above the 200-day moving average. I like this at the 210 level, and I would put a stop loss at the 202 level. Now, another stock I like, and this is also an exchange stock. This is Chicago Mercantile Exchange. This is Chicago Board of Options Exchange. Notice, same exact pattern. Look at these two stocks. Let me go on a 6-month basis. This is 6 month, and this is 6 month. Look at these two stocks. It swung up high, higher high, swung up high, higher high, down for 3 days. Are they mimicking each other, or is it just my imagination? Of course they're mimicking each other. Option volume is at a record high right now. I talked to Tony Saliba a few weeks ago. He owns a trading a firm, a brokerage company, and he was telling us that people are opening accounts left and right. Account openings are at a multi-year high. People are taking this stimulus checks. They're going to be getting the cash portion, and they're going to be putting it back into the market. That's what happened when they got their first stimulus check. Remember Robinhood, all that stuff? We're going to see part two. So the fact option volume is heating up. I like this stock. I like it near the 104 level. Put a stop at around the 101 level. Risk one, profit 2 times my risk. Same thing with CME. Put a buy stop right here at the 210 level. Put a stop loss at the 202 level, and ride the sucker 2 times profit to risk. So you basically take the risk, you multiply it times 2, and you add it to your entry. That's your profit target, just FYI. Now, folks, I've got something big for you. This is going to be a very, very exciting week, and I mean that. I mean, really, I've got some really good news for you. Wall Street legend Chuck Hughes, he's already helped traders all around the globe reach their dreams. He sure has. But now, he's ready to reveal his most shocking discovery yet. Chuck's discovered a brand new strategy to target weekly profit opportunities, regardless if the stock market is up, down, or sideways. And that's pretty helpful with the Nasdaq kind of being between the twilight in the twilight zone, which means it's between the 50-day and the 200-day line, which means it's kind of sideways right now and choppy. This is perfect for the current market environment. Again, regardless if the stock market is up, down, or flat, twilight zone, Nasdaq 100, choppy. Oh, this is perfect. Perfect. I mean, the timing just couldn't be better. In fact, this is the formula that helped Chuck lock in his 96.3% win rate. I'm going to repeat that again. This is the exact formula that helped Chuck lock in his 96.3% win rate, even when markets are turbulent. And now he's about to share it with the world for the first time ever. Man, I'm excited. Folks, you cannot miss this profit opportunities. Regardless, making money, regardless if the stock market goes up, down, or sideways. Nasdaq 100 sideways right now. 96.3% success rate, multi-year 96.3% success rate. He's going to share it with you guys. Follow the link below, check it out now, and access the formula now. I am so excited about it. Chuck and I were talking about it this weekend. I couldn't sit. I mean, you should have seen me. I was like bouncing like a yo-yo. I was so excited. Follow the link below. Learn 96.3% success rate. I'm going to be with Chuck talking all about it. You've got to learn about it. Access the formula now. Find out all the nitty-gritty. And make sure to like this video and subscribe to this channel if you're watching on YouTube. Stay ahead of the market and by being the first to notified when we post new videos. Subscribe, click the button, get in on our stuff, and follow Chuck. You got to learn about this formula. Follow the link below, and I'll talk to you guys later. And have a great, great week ahead. There's going to be some volatility with the Nasdaq being where it is, and all of this job data, the Fed report. We got to figure out what the FOMC is going to talk about, interest rates, inflation. There's a lot of stuff this week. I want to make sure you guys are in on it, and I'll talk to you guys later. Bye.